Hi everyone, good evening. Few minutes beyond the starting time. Sorry, there was a bit of a technical difficulty. So let's start off where we stopped. Okay, and we are on transfer pricing, which we are supposed to look at where we stopped yesterday. Okay, but before I get into transfer pricing, I was looking at a question yesterday. Okay, and I wanted you guys to give me an answer on it, which was this one. Okay. So is everyone there? Can I have a bit of a shout out? Hi, great. Okay, hi everyone. Welcome back again. So right, so we are on this question. Can you guys put out a answer for this? Thanks, guys. Thanks. So this is from the specimen exam. Let me try to make this bigger. Sorry. There you are. Better. I await your answer. So I see some answers coming in. Answers are D, C, few B's as well. So let's quickly discuss. Okay. Deaf Company provides accounting services to government departments. On average, each staff member works 6 chargeable hours per day, with the rest of their working day being spent on chargeable administrative work. One of the company's main objectives is to produce a high level of quality and customer satisfaction. Deaf Company has set its targets for the next year as follows: cutting department expenditure by 5%, increasing the number of chargeable hours handled by advisors to 6.2% per day, obtaining a score of 4.7% or above on customer satisfaction surveys. Okay, right. Cutting departmental expenditure by 5%. That is directly related to the term called economy. So basically, if you're focusing on cutting down costs, etc., that's economy. So your answer has to be A or D. Increasing the number of chargeable hours handled by the advisors. Yesterday also, if you remember, I was saying efficiency is something like productivity, trying to get more output for the same input or trying to get the same output for a reduced input. So on that note, the second term refers to efficiency. And finally, obtaining a score of 4.7, that is basically an indicator which shows that I'm doing what I'm supposed to do right. Okay. So effectiveness. So answer D is the correct answer. Okay, right. So great. So majority on answer D. So we're good on that. Okay. So great to have correct answers. So moving on, there were two more other MCQs. Okay, it's MCQ time again from the same specimen paper. Can I get an answer for this? So like what I said yesterday, if you can remember while you try to get this answer, okay, most likely that this section of the syllabus, that is information systems, okay, will not be tested as a big question. Okay, coming into section C, they don't ever say anything like that, but not that they have ever included it. Okay, can they include it? Maybe, but then again, my judgment would be not necessarily for a complete 20-mark question, maybe a piece if at all, but more prominence given to MCQs. Okay, right. So answers coming in tell me that it is Uh, we are on B, C, A, and D. Oh, we have sorry, B, A, and D. We've all answers there. Okay, right. So on that note, okay, management information systems summarize internal data into periodic reports. Yes, it does that. Transaction processing systems, the lowest type of software which is used, where including supermarkets, checkout counters, what they use to gather the data is a TPS, will facilitate the immediate processing of data. EIS will utilize dashboard facilities and interactive graphics. Okay, that's also correct. And finally, ERPS, that's the uh, system which takes every aspect of the organization into account, can be set up with extranet links to suppliers and customers. So we are on all four correct answers. Answer D for desk. Okay. So a quick one more, an MCQ again from the specimen paper itself. Okay. The following are all types of cost associated with management information. Use of barcodes and scanners, payroll departments, processing of personnel costs, completion of timesheets by employees, input data into the production system. There's a C, there's a D, there's an A. Guys, there's only one answer. Lot of us. Direct data capture means someone, Mohammed wants to know, Wazim wants to know, okay? Direct data capture means basically a technique that I use to capture data directly. Now, for example, a barcode reader will capture the data directly. Okay. A scanner will capture the data directly. Okay. So a mechanism which I use to capture the data directly, okay, is what we call a direct data capture technique. Okay. So on that note, use of barcoding and scanners is direct data capture. Okay. Are you capturing data by payroll departments processing? No, that's not capturing data. As they say itself, it's processing. Okay. And completion of timesheets by employees. Yes. Through the timesheet, you're capturing some amount of data. And finally, input of data into the production system. That also is a no-no. So on that note, your answer is 1 and 3. Okay. So I want to show you something which I came across. Okay. Uh, ACCA PM. A very recent question which had been tested. Uh, just a second. Examiners reports. Yes. I don't know if you saw this. Yeah, this was what I was planning to show you guys. So now the recent past papers, okay, will not give you any of the MCQs. It just gives you question 31 and 32. And let to, like what I said, for 2 sessions, they'll give you just 2 questions. But if you actually go through the examiner's guide, okay, they give you an idea about the questions tested for section C, no details about the questions tested for section B, And generally they throw in two MCQs. I want you to focus on this MCQ. The following costs relate to management accounting information for Kite Company for April 20X8. So this is, now you might wonder, this is information systems. Why are they giving numbers and why are they asking me questions connected to numbers? Okay, right. So they are asking you what is the total direct data capture cost. So if you had tried the question that I did from the specimen paper, you easily have that answer. Okay. So employee time spent by filling in the timesheets. Okay. So now we had this no completion of timesheets by employees. Did I take that? Yes, I did. So on that note, I'm supposed to take the 600. Use of barcodes and scanners to record inventory. Did I take the use of barcodes and scanners? Yes, I did. So take that as well. Storage of sales information no longer needed. That has nothing to do with direct data capture. And time taken by staff to input data into the production system. So here I said we are not going to take this. Okay. And we are not going to take payroll department's processing cost. So if you actually went through this specimen paper question, you easily have a 2 marks in terms of that real exam question which appeared for December 2018. Okay. That is obviously if you got that question. Okay. Right. So just wanted you to look at that as well. Right. And then we move on back to this. Okay. So we move on to this topic called transfer pricing. Okay. So transfer pricing, okay, before I go there, let me see. Yes, the answers are given. Yes, 800. Yeah, so that was right. Okay. Right. What is transfer pricing? Okay. So transfer pricing is this scenario where, okay, if I'm to draw this through a picture, okay, so you have the parent company who owns maybe two subsidiaries, okay, a seller and the buyer. Okay. So transfer pricing is where what is the price at which the seller sells it to the buyer, a buyer within the same group. Now, at the same time, there are external customers who are willing to buy this from the same seller. Now, this is not a transfer price. This is what we call a market price. Don't confuse transfer price with market price. Okay. I hope everyone's clear in what I'm doing over here. Okay. Right. So a transfer pricing question can be, especially a big question, can be one out of three types. Question one is where they will tell you, okay, right, this is the transfer price. For example, it's $10. Do the calculation. Question two is where they will probably not tell you it's $10, but they will say it's marginal cost plus 20%. So through this, you will have to compute a transfer price and based on that, do the necessary calculations. Okay. Question three is the bit of a tricky one where they will tell you, okay, find a suitable transfer price. So compute a suitable transfer price and based on that, maybe do certain calculations. Okay. So this is the main guideline. Trust me, just follow these principles a little bit. Lot of people assume that this section's really hard. It's actually not once you get your logic together. Okay. And the suitable transfer price again is always on principle marginal cost plus opportunity cost. So you don't have to think there as well. If they say pick a suitable transfer price, go with marginal cost plus opportunity cost. Okay. So these two, of course, okay, the examiner has to give that to you. It will be given, the price and the technique. Okay, fine. So I hope you have a brief idea of what on earth we are doing right now. Okay, right. In terms of this transfer pricing, what is the examiner's expectation is going to be. Right. Objectives of the transfer pricing system. There's goal congruence, and then there's what is goal congruence? Basically, what they're trying to say is all three parties, that is the parent, the seller, the buyer, should work on the same goal. Okay, which is basically the benefit of the whole organization. To measure performance, at the same time, autonomy must be there in this. What is autonomy? Seller has to decide the price autonomously without any interference. He has to have the freedom. Buyer also should have the freedom. Minimizing global tax liability. Sometimes when the two companies, the seller and the buyer, are on two different geographical grounds, two countries in other words, there can be different tax rates. So sometimes you manipulate the pricing to benefit from taxation. Okay, ideally a slight manipulation, I guess, is okay, but if you're manipulating massively, that's actually some illegal aspect. Okay, to record the movement of goods and services. Okay, and to make sure that there's a fair split of profit between the divisions. Okay, so let me clear this and let me move on to the next slide. So the transfer pricing, the general rule is like what I said, marginal cost plus opportunity cost. In a perfectly competitive market, it's the market price. If spare capacity exists, it's marginal cost. So just to let you know, even if spare capacity exists, it is actually marginal cost plus the opportunity cost. But in that case, the opportunity cost is equal to 0. Okay. So actually there's, in my view, there's no two things called marginal cost and marginal cost plus opportunity cost when it comes to transfer pricing. It's the same thing, but it's just that when spare capacity exists, that the opportunity cost is 0. Okay, right. So these are the main aspects. So I move on to the next slide, which asks me or tells me the transfer pricing systems, that is market pricing, cost plus a profit, or probably a negotiated price where the two parties sit together and agree on something. So then we go on to Mob company to finish our yesterday's presentation. Okay, go to yesterday's handout and let me see this. Okay, page number 8 of yesterday's handout. Right. So before I go into this, let me take a, I don't know if it's a question. Let's see. Yes. Kindly discuss cases of transfer pricing where there exists limited or unlimited demand. Okay. Can you explain the third point again? Okay. What is the third point? I believe the third point is autonomy. Autonomy means the two companies under consideration, the seller and the buyer, they need to have their own freedom in deciding a selling price and a buying price. Okay, so the parent mustn't influence on that. Okay, right. uh, Cases of transfer price, limited, unlimited demand, we look at it through the question. Can you explain opportunity cost? Opportunity cost is basically the value of the next best alternative forgone. So what they're trying to say is when there is no spare capacity to sell it to the internal buying division, you have to sacrifice on an external sale. What's the money you lose from that external sale based on the sacrifice? That's your opportunity cost. Okay. So there's a requirement or request to explain the fourth point, minimizing global tax liability. Okay, it's not going to be it's not in our syllabus directly, but just know it's there. Okay, Minimizing global tax liability meaning, so two people want the same explanation actually. So that means, uh, like what I said, now I think some of you guys are from Pakistan, I'm from Sri Lanka, okay? So let's say I'm exporting tea from Sri Lanka to Pakistan, okay? My tea factory and the buyer in Pakistan, or let's say company X in Pakistan, and the tea factory is owned by the same person, although in two different countries. So his factory is in Sri Lanka, his sales outlet is in Pakistan. Okay. So now, if Sri Lanka makes a big profit, Sri Lanka will have to pay a big tax. If Pakistan makes a big profit, Pakistan will have to pay a big tax. Okay. So ideally, if the tax rate in Sri Lanka is higher compared to Pakistan, what people tend to do is make the Sri Lankan profit lesser and the Pakistani profit greater. So if the Sri Lankan profit is lesser, you pay a lesser tax here. If the Pakistani profit is greater, you pay a greater tax over there, but it's okay because I'm on a lower rate in Pakistan. So that's fine. So that's about this minimizing the global tax liability. You just have to know a brief idea about it. Okay, right. Transfer pricing plus opportunity cost means we will deduct the opportunity cost. No, you must add the opportunity cost, Hassan. Just give me a minute, you will understand through this question. If there is spare capacity, why do we have to take the opportunity cost? We actually don't have to take the opportunity cost, but that's why I said opportunity cost is zero if there is spare capacity. But what I meant was, you're talking about a common mechanism. So if you go with marginal cost plus opportunity cost in both cases, it's actually one technique. Okay, that's what I meant. Right. So coming back to the question, oh, just like relevant costing, we are supposed to add the opportunity cost? Yes, yes, something like that. Okay, right. So the question, Mob company manufactures electronic mobility scooters. The company is split into two divisions, the scooter division and the motor division. Okay, so can I hope you can see this. Okay, scooter division and the motor division. Division M supplies electronic motors to both Division S and to external customers. The two divisions run as autonomously as possible, subject to the group's current policy that Division M must make internal sales first before selling outside the group, and that Division S must always buy its motors from Division M. However, this company, together with the transfer price with Division M, charges Division S, uh, which Division M charges Division S, is currently under review. Okay, right. So let me draw a bit of a picture. Okay, Mob company has two divisions, the motor division and the scooter division. Okay, so the motors are made and supplied to scooter, and the motors are also sold to, like what I said, external parties. Okay, right. Division S. Division S's budget for the coming year shows that 35,000 electronic motors are needed. So these guys need 35,000 motors. And then an external supplier could supply the division for 800. Okay, so now there's another outside guy coming into the picture who's saying, let me give it to you for $800. Right. Division M has the capacity to produce 60,000 motors. So these guys want 35. Keep that in mind. Details of Division M's budget which has just been prepared for the forthcoming year as follows. So budgeted sales volume is 640. Selling price for external motors is 850. So you're selling for 850 over here. And selling price. And the variable cost for external sales, they say, is 770. Right. The variable cost per unit for motors sold to division S is 30 less. So the internal variable cost is 740, by the way. 770 minus 30. Okay. External demand is 30,000 motors. Right. Now, there were questions asked about opportunity cost, etc. So the first thing is, do I have a capacity constraint as department or division M? Yes, I do. I can make only 60. There's demand for 65,000. Okay. So first thing I do is generally, okay, now 65 minus 60. How much is that? That's 5. Okay. This is the capacity problem ideally. I have 5,000 less, okay, than the demand. Deduct that 5,000 from here, okay. Deduct that 5,000 from here as well. Listen to the whole story first. So when you do that, you get 25,000 there and you get 30,000 here. So M will not hesitate to supply externally 25,000 at market price. And what is my market price? Market price is 850 as mentioned. Sorry about that, just ignore that. Market price is 850. Okay. So externally, that is. And he will not hesitate to supply internally, like what I said, 35,000 minus 530. At what price? At marginal cost, which is at the rate of 740, which is the variable cost. Okay, I'll come back to that a little bit later on the 740, don't worry. Right. Now the big question is, who will you sell this 5,000 to? Okay, I said we'll go on cost plus opportunity cost principles because there is an opportunity cost. Preferred buyer is always your internal buying division. Try to sell it to S. Okay, internally, let's sell it to S. At what price? Not at marginal cost though, at marginal cost plus opportunity cost. Okay, so which is going to be at the rate of, by the way, what is the opportunity cost? The contribution that I lose, 850 minus 770 is 80. So we are going to go on 740 plus 80. And I will tell my internal guy, okay, department S, please understand, these 5,000 units, I have to sell it to you for 820 because to get that same profit, I need that price. Because if you reject this order, I always have a ready buyer in the form of the external customer who is willing to buy at 850 itself, not at 820 also. I'm giving it to you for 820 because I have a $30 saving when I transfer it to you. Okay. Are you interested? And he will say, no, I'm not interested because I've already got a quote from someone else who said who will give it to me for 800. Okay. So on that note, I will reject the offer coming from M, who is IS. So then M says, no problem. Okay. I'll give that to the external guy at the market price. Cut all of this. Okay. At the market price. which is 850. Done. So effectively 30,000 sell it internally, externally at 850. 30,000 sell it internally. I wouldn't say at 740. If you remember, I said I'll come back to that. Like yesterday, anything between 740 to 800, by the way. Okay. So not anything more than 800, but at the same time, nothing below 740 as well. Okay. So this is what you have to put down in words. Okay. This is nothing very difficult. Every question works on this basis. Okay. Assuming that the group's current policy could be changed, advise a suitable calculations, the number of motors which division M should supply to division S in order to maximize group profits, recommend the transfer price. So this is the recommended transfer price. Okay. Right. So will you not please solve this question on an Excel sheet? We will be able to know the exact format to solve the question. Honestly, to tell you, like what I was telling you yesterday, okay, since this is okay, right, I believe I understand where this is coming from, okay. Now you're gonna get a sheet of paper or a plastic piece of paper with a marker pen for you to do your rough workings. Now, what you see in terms of what I have done has to be done on that rough sheet of paper, or ideally that plastic sheet with the marker, to get an understanding of the answer. Okay. This is a discussion question. Okay. Recommend the transfer price. Okay. Where I'm supposed to use calculations as well. So in which case, like what I said yesterday, I have my doubts in them giving me an Excel sheet to do this answer, because I have to write an answer as well. So this will come in a Word document. So if it comes in a Word document, let me show you how it's supposed to be done, okay, through the suggested answer. Okay, right. So there's a question: 30 less variable cost or market price. I don't understand the question, Asif. Okay. So is the transfer price 820? Yes, it is 820, Lahan, in terms of this 5,000. Okay. But at 820, they're going to reject that offer because they already have a supplier who's willing to go for 800. So therefore, I will not go ahead with it and transfer it to the external party itself. Okay. Right. 770 minus 30. You're welcome, Lahan. 770 minus 30 or 850 minus 30. It's actually, when you say marginal cost plus opportunity cost, it's 770 minus 30. That's the marginal cost plus the opportunity cost of 80, which gives me 820. Most of the time, a similar shortcut will work where 850 minus the 30 will also give you that same 820 answer, but you're going a little against the principle. Okay, right. Why don't we sell internally 35,000 units? Simple. Like what I said, I am willing to sell internally 35,000 units. 30,000 at 740 and 5,000 at 820. It's just that he doesn't want that 5,000 at 820 because he knows that he has a supply for 800. Okay, that's why that's not happening. Okay, is the 740 the transfer price? Yes. Not like what I said, not necessarily 740. We can agree on anything between 740 to 800. Okay. By the way, can you take a screenshot of this? I'm going to clear this just in case you need it, unless you have already taken it down. Right. I clear it. And here you go. Okay. Let's make this a little bigger now. For every motor sold externally, division M generates a profit of 80. That is 850 minus 770. Okay, just look at this, will you? This is them saying the exact same thing that I said. This is the examiner says, what he says. So like what you can see, if this is the suggested answer, I have my doubts, then giving a Excel sheet for us to do this. For every motor which division S has to buy from outside the group, there's an incremental cost of 60 per unit. That is 800 minus 770 minus 30. Okay. So therefore, from a group's perspective, as many external sales should be made as possible before any internal sales are made. This is them saying it in a different way, the same thing that I mentioned. Consequently, the group's current profit will need to be changed. Policy will need to be changed. This does, however, assume that the quality of motors bought from outside the group is the same as the quality of the motors made by Division M. Division M's total capacity is 60,000, externally 30. It can only supply 30,000 of Division S's demand for 35,000 motors. These 30,000 units should be bought from Division M since from a group perspective, the cost of supplying these internally is 60 per unit cheaper than buying externally. The remaining 5,000 motors required by Division S should then be bought in from the external supplier at 800 per unit. So in order to work out the transfer price, which should be set for internal sales, okay, so M's perspective, they are not going to go anything below 740, like what I said. S's perspective, at the same time, they are not going to go anything beyond 800. So in summary, like what I told you guys, okay, it has to be set somewhere between 740 to 800. Okay. From the perspective of the group, the total group profit will be the same, irrespective of whatever. That's why Mob company wouldn't actually really care what the price is, as long as it's anything between 740 to 800. Okay. But obviously, it has to be a fair price where the managers and the staff remain motivated. Okay. Given the external sales price which Division M can achieve and the fact that Division S would have to pay 800 for each motor bought outside the group, the transfer price should probably be set at the higher range. Okay, so meaning something like close to 800. Okay, right. So that concludes all aspects connected to yesterday's presentation, which we couldn't wrap up actually. Right. In the question, it is told that the current policy can be changed. Does this mean that we can sell 30,000 externally and 30,000 internally, but buy the rest of the 5,000 from the supplier? No, you must understand, okay, based on the picture that I drew, okay. Yes, sorry, Hassan, you are absolutely right. Yeah, okay. Why is the price between 740 to 800? Because see, anything within that range is fine. Okay, so you are going on that principle of a price between the marginal cost and the market price. Okay, uh, should the right transfer price be 780, as M will not lose 20 opportunity cost and the group will keep 50 profit from these 5,000 units? No, the right transfer price should be 820 if you're referring to those 5,000 units. Okay, that is based on the cost plus opportunity cost mechanism based on the calculation that I showed you. Okay, is the transfer price set only for spare capacity? The market price is what we usually take for spare capacity. Okay, but if we have a capacity constraint, those capacity constrained units is what we will have to consider as opportunity cost units. Okay, that's why we were taking the opportunity cost only for the 5,000 units. Okay, right. uh, how 60 per unit be calculated? Kindly explain a bit from a buyer perspective and the group's perspective. What is this 60 per unit? Why am I missing this 60? I don't see a 60. If it's the difference between 740 and 800 that you're referring to, that's not a 60. That basically simply says that you can sell it at a price between that 740 and 800. Okay. That's a different perspective. That's okay. Okay. the incremental cost of 60. Okay, so this is basically the same difference. Okay, like what I was this difference between 740 and 800. Okay, so that's 60, correct? Okay, fine. So I'll get out of this and we'll move on to ideally what we were supposed to do today. Okay, that is, again, it's me, Shehan. Okay, moving into day 2, okay, of the presentation of P2P, that is budgeting and control, refers to variance analysis as well. So to briefly touch on certain areas, there's a question again on the transfer price. If A can make 6,000 units, external demand is 3,000, but M department get cheaper from outside all of this, then will buy internally or externally. So technically, if M can buy it cheaper from outside all the units, they should buy it from outside. Okay, there is no reason why department the supply should exist. Okay, even though it's an internal department. Okay, so I'm sure you have, even in whatever country you guys are in, the imported product is cheaper than the manufactured product, the locally manufactured product. So it actually, in a business point of view, okay, yes, we know concepts of protect the local farmer, etc. But then again, in a cost point of view, it's actually cheaper to get it from outside. Okay. Can I ask a question related to yesterday's lecture? Abdullah, if you don't mind, hold on for a little bit. Okay, during the break, you throw it to me. Okay, I'll answer it for you. Right. So the purpose of budgets: forecasting, planning, control, communication, coordination, evaluation, motivation, authorization, and delegation. Okay. So these are some of the purposes of budgets. And then budgets and performance management, responsibility accounting. Responsibility accounting divides the organization into budget centers, each of which has a manager who is responsible for its performance. The budget is the target against which the performance of the budget center or the manager is measured. So in simple words, okay, I am putting someone responsible for a budget center. Okay, he is responsible for all aspects controllable happening within that responsibility center or budget center. So, and the accounting aspect behind what is done is what we call responsibility accounting. Management by exception, few matters to consider: set up standard cost and prepare budgets and set targets. Okay, compare that with the actual, okay, or measure the actual and then do a comparison, and basically investigate the reasons or differences and take action. So behavioral aspects of budgeting, key issues: dysfunctional behavior. So that is basically you creating problems within the organization, your behavior not being very normal. Okay. Goal congruence. Okay, trying to achieve goal congruence, especially when trying to achieve goal congruence. Okay, because sometimes certain individuals try to act to the best interest of themselves or their department, not necessarily the organization. Another problem is budget slack. So basically refers to the fact that you are purposely overstating your cost or understating your revenues so that you can easily achieve your targets. Hopwood introduced, I'm just touching on the key areas theoretically, 3 management styles connected to budgeting. So there's something called a budget constraint style, and a profit conscious style, and a non-accounting style. Okay. According to his research, he said managers who used profit conscious style and non-accounting style actually performed better than the guys who were actually constrained by trying to fit all their aspects and meet the requirements of the budget. Target setting and motivation, expectations versus aspirations. Okay, so we have what we call expectations budget and an aspirations budget. So something like an aspirations budget is
you starting up a new business and trying to become the number one in the country, okay, immediately. Okay, but over time, yes, that's the target that you're trying to achieve. So ideal targets, okay, coming in from aspects like ideal standards, the target should be communicated in advance, dependent on controllable factors. So like what I told you before, it has to be a controllable factor, okay? So don't hold someone responsible for something he or she cannot control, based on quantifiable factors linked to appropriate rewards and chosen to ensure goal congruence. Participative budgeting. Advantages of participative budgets, okay? Increased motivation, should contain better information. In These are the pluses, okay, because if you are involved in setting the targets, you are now motivated, okay. And there is a possibility that the person involved in, basically the junior, not the boss, the subordinate, he probably sometimes knows what's happening around a little better than the boss also, because generally a boss is someone who sits at office, but the subordinate is the one who runs around, okay. So should contain better information, increases managers understanding and commitment, because you are involved in preparing the budget, you are a more committed person now to achieve that budget. Better communication, and if the subordinate is involved in preparing this, the senior managers can concentrate more on developing the strategy for the business. Disadvantages: loss of control, inexperienced managers. What is this loss of control? Sometimes there's a tendency that you get them to prepare the budgets and they try to overrule you, okay. Inexperienced managers, so basically they don't know how to prepare participative budgets, or basically a budget to begin with. Budgets not in line with the objectives, understandable. Preparation slower, and disputes can arise because two people have to agree on something now. Budget slack: when you ask them to prepare, they purposely overstate the revenues and overstate the costs and understate the revenues, so that you can easily achieve your targets. Certain environments may preclude participation. So then, main aspects theoretically which can be tested when it comes to budgeting is what you see over here. Rolling budgets, a year broken into 4 quarters. When the first quarter is done, 3 quarters remain. To that, you add another quarter. So when industry is a little uncertain and dynamic, they advise you to go for rolling budgets. Periodic budgets is where you prepare a budget for a specific period. So although you have 4 quarters, you wait till the 4 quarters are over to prepare for the next 4 quarters. Incremental budgeting: take the previous budget and do an inflation and quantity adjustment. Zero-based budgeting: start the budget from scratch, assuming it's a zero. Okay, so we have aspects like decision packages coming into this context of zero-based budgeting. Okay, activity-based budgeting based on ABC principles. Feed-forward control: basically forecast your problem and make sure you find a solution to the forecasted problem before it actually happens. Flexible budgeting: selecting a budgetary flexible budgeting is we'll do a small question today. Selecting a budgetary system. So now we have so many systems, which is the best out of all of this? Okay, so depends on the industry that I'm in, the purpose that I need the budget for, so on and so forth. How do you deal with uncertainty? Sensitivity analysis, scenario planning, etc., including flexible budgets, and a little bit on the use of spreadsheets. Okay, so like what I said, periodic budgets, you're preparing it for a particular time period. Rolling budgets, I told you what that means. Incremental budgeting, okay, so I told you what it means. It's suitable for stable businesses where costs are not expected to change significantly. Okay, zero-based budgeting. So how is it done? If you remember, I mentioned about the decision packages. Identify all possible services and then cost each service. Rank the packages. Identify the level of funding that will be needed. Use up the funds in the order of the rankings. So we have a question on page 1 from today's handout. Listing regional authority. Okay, make this 100. Okay, Right. Before I go there, kindly discuss the question of kappa limited in standard costing. Thanks. Okay. I don't know if you saw that. That's at the end of this particular handout. I'm going to do a mix and yield. If I have time, I definitely will do that. I have placed that as an extra question. Okay. Since transfer pricing was examined in December 2018, can we say that at least it is likely to appear in March 2019? I'm sorry, I can't confirm anything like that. Just because it was tested, Osama, previously, that doesn't mean it will be tested again. Okay. Discuss budget constraint management styles. So that is Wasim, basically budget constraint management style is basically where but you will try to stick to your budget somehow. Okay, and you are so constrained where you are trying, always thinking to yourself, I must meet this target, I must somehow hit this target. Okay, and you're so pressured by trying to meet this target, you are actually losing focus on other aspects which actually can basically be used to improve profits or benefit the organization. Okay, can you explain once again feed forward control? So feed forward control is where ideally you forecast initially and you compare what's going to, or basically you forecast the problem. Okay, and you see that something's wrong, that's why it's a problem, and take a necessary step to make sure that you overcome that forecasted problem. So for example, an example of feed forward control is basically what we call a cash budget. So I prepare a cash budget for the next 3 months, and in the second month there's a cash deficit, so I see a problem. Okay, and I take necessary steps to make sure that the problem is rectified by arranging a bank overdraft or a bank loan. Okay, so Hafiz, I hope you got that. uh, Flexible budgets, I'll come back to that today through a question itself. Okay, right. So let's look at this. Listing regional authority is responsible for the provision of a wide range of services in the listing region, which is based in the south of the country, Alaya. Okay, these services include, amongst other things, responsibility for residents, welfare, schools, housing, hospitals, road, and waste management. Over recent months, the listing region experienced the hottest temperatures on record, resulting in several forest fires, which caused damage to several schools and some local roads. Unfortunately, these hot temperatures were then followed by flooding, which left a number of residents without homes and saw higher than usual numbers of admissions to hospitals due to the outbreak of disease. These hospitals were full and some patients were treated in tents. Okay, so not the best context there. Residents have been complaining for some years that a new hospital is needed in the area. Prior to these events, the LRA was proudly leading the way in a new approach to waste management. With the introduction of its new waste recycling system, 2 years ago, it began phase one of the scheme, and half of its residents were issued with different colored waste bins for different types of waste. The final phase was due to begin in a month's time. The cost of providing the new waste bins is significant, but LRA's focus has always been on long-term savings, both to the environment and in terms of reduced waste disposal cost. Okay, so at the moment we have a problem in terms of a hospital which is having insufficient space. Okay, before that they were trying to introduce a waste recycling system. Okay, where you provide colored bins for different types of waste. LRA is about to begin preparing its budget for the coming financial year, which starts in 1 month's time. Over recent years, zero-based budgeting has been introduced at a number of regional authorities in Alaya, and given the demand on resources which LRA faces this year, it is considering whether now would be a good time to introduce it. Okay. Right. Discuss the main steps involved in preparing zero-based budgeting. So I gave this to you in the handout itself, okay, or the PowerPoint, okay. But they say describe. So if you can go into a little more detail than just a bullet point, a short bullet point, I think it would be ideal. Okay. But this question has nothing to do with LRA over here, or listing regional authority. Okay. This is a theory question, a general theoretical question. Okay. Right. So on that note, okay, this is how the marks are allocated. The steps: identification of decision packages and ranking. Okay. So step one, now one might say, uh, just a while ago when you showed it in the presentation, there were four things or four steps, but here we have only three. It's like this, guys, don't worry about the number of steps. If you want to go into 6 steps, go into 6 steps. If you want to complete in 2 steps, that's also fine. But make sure all aspects within this is properly covered. So if you're merging 2 steps, that's not a problem as long as you merge it properly. Right. Activities are identified by managers, and managers are then forced to consider different ways of performing the activities. These activities are then described in what is called a decision package. Okay. So there was a question which asked what is a decision package. Okay. Something which analyzes the activity, states its purpose, identifies alternative methods of achieving the same purpose, establishes performance measures for the activity, assesses the consequences of not performing the activity at all or of performing it at different levels. As regards this last point, the decision package may be prepared at the base level, representing the minimum level of service or support needed to achieve the organization's objectives. Okay. So ideally, in maybe like the case of the hospital, okay, what is the uh, dire need in terms of the number of beds needed? So the lowest requirement is probably what they are talking about here through that. Further incremental packages may then be prepared to reflect a higher level of service or support provided. Okay. So at the moment, there are 100 patients in the tens. So how to get that 100 beds organized, what's the cost and what's the other matters that we need to look at, mainly the cost aspect. But if it's 200, how much more do I need? If it's 300, how much more do I need? So those are the further incremental packages that they're talking about. So then you rank the packages in order of the decreasing benefits to the organization, which will help management decide what to spend and where to spend it. The ranking of the packages happens at numerous levels of the organization. I must tell you, sometimes there can be certain biases when it comes to ranking based on individuals' judgments. The resources are then allocated based on the order of priority and spending. Then we have discuss the problems that LRA may encounter if it decides to introduce and use EZBB to prepare its budget for the coming financial year. Okay, right. So if I'm to briefly touch on the answer in terms of the problems, okay. So like what they said, okay, at present they are finding basically it finding itself facing difficult circumstances. The fires and the floods, okay, means that you need to spend or take urgent action, and expenditure needs to be spent on schools, roads, and hospitals. Okay. Uh, Listing is facing a crisis situation, and the main question is therefore whether this is a good time to introduce anything new. Okay, so we are trying to introduce EZBB amidst all these problems. So I also personally think not the best time to introduce something new. Okay, because you have to have your existing matters settled first, which doesn't seem to be the case. The introduction of EZBB in any organization is difficult at any time because of the fact that the process requires far more skills than, for example, incremental budgeting. So not everyone will know how to handle EZBB properly. Managers would definitely need some specialist training, as they will simply not have the skills which they would need in order to construct decision packages. So not everyone is a EZBB expert. This then would have further implications in terms of time and cost, and at the moment, both of these are more limited than ever for LRA. When so many costs are being faced by the LRA, can it really consider spending money on training staff to prepare and evaluate decision packages? Given that the budget needs preparing imminently as the new financial year is approaching, it is really too late to start training staff. With EZBB, the whole budgeting process becomes a lot more cumbersome as it has been started from scratch. Okay, so EZBB, as I said, you have to forget everything that happened in the past. This is the exact opposite of incremental budgeting, which says take your past data and let's do a small adjustment. This says forget your past data completely. So we're going to prepare a budget from the beginning. There is a lot of paperwork involved, okay, in and the whole process of identifying packages and determining their costs and benefits is extremely time consuming. That's actually one of the weaknesses as well. Okay, there are often too many decision packages to evaluate, and then after that to be ranked. The LRA provides a wide range of services, and therefore it's obvious that it would be a really lengthy and costly process to introduce. At the moment, some residents are homeless, okay, where their houses and schools have been damaged by fire. So the question is, in a situation like this, is priority introducing the EZBB process? Okay, the last para, another problem that it can cause conflict to arise as departments compete for the resources available. Okay, now while the hospital problem is there, they're trying to do a recycling project as well. So where do you allocate the funds? So there can be uh, problems where different departments have some infighting among them to share this limited funding available. Okay, so the final phase of the scheme may be postponed, that is in terms of the waste recycling system. This is likely to cause conflict between departments, as those staff and managers involved in the recycling scheme will be disappointed because it's postponed. The last piece of the question, okay, for each benefit you get 1 mark. So 3 benefits would do overall. Outline 3 potential benefits of introducing ZBB. Okay, right. So as you can see, they say outline. So when you say outline in terms of the verb, okay, a massive explanation I don't think is really necessary. Okay, and 1 mark each. Okay, so a 2-3 line answer, 3 answers like that will give you 3 marks. So as they say, don't get worried through this, because they actually say we need only this 3. Okay, so EZBB will respond to changes in the economic environment, since the budget starts from scratch each year and takes into account the environment at that time. This is particularly relevant this year after the fires and the floods. Without EZBB, adequate consideration may not be given to whether the waste management scheme should continue. But if EZBB is used, the scheme will probably be postponed, as it is unlikely to rank as high as expenditure needed for schools, housing, and hospitals. Okay, fair enough. No? If any of the activities or operations of LRA are wasteful, EZBB will identify and remove them. That's a big plus. Okay. Managers may become more motivated as they are also involved in putting the budget together. So a participative approach encourages a more questioning attitude. Okay, it leads to efficient allocation of resources, and all the organization's activities and operations are reviewed in depth, because you're going through it one by one as if you're preparing a budget for the first time. And EZBB focuses its attention on output in relation to value for money. This is particularly important in the public sector. Okay, that is where the 3 E's are often used to measure performance. Okay, right. So let me take, I think there's some of the questions. Can you explain what is
a mutually exclusive package and an incremental package? Okay, yes, I can. What about last year's activities? Uh, Last year's activities for EZBB, you generally don't take into account. Okay. Okay, in terms of mutually exclusive, so mutually exclusive means, as in set theory, two things cannot happen at the same time. Okay. So ideally, I will have to pick one over the other. That's what you mean by mutually exclusive. Incremental means, like what I was saying, an incremental package is where uh, you have, let's say, you're trying to, as a government, you're trying to build up a sports stadium. Okay. How many chairs, or what's the seating arrangement that you're looking at? What is your expected audience on average? How many seats are you going to fix over there? So you can go a 50,000. Incremental package will say, okay, if I'm making it 60, what is the increase in the cost? If I'm making it 70, what is the increase in the cost? Okay, fine. So activity based budgeting. So like what I said, based on ABC principles, identify the cost pools and the cost drivers, calculate the budgeted cost driver rate, and uh, according to produce a budget for each department or product by multiplying the budgeted cost driver rate by the expected usage. Okay. Feed forward control, okay, is defined as forecasting the differences between the actual and the planned outcomes. So, but ideally, like what I said, this has not happened yet. And then we move on to a question connected to flexible budgets. Okay. So, but before going there, okay, selecting a suitable budgetary system, like what I said, that depends on the type of the organization, the type of the industry. So, for a stable organization, we don't need a rolling budget. Sometimes the rolling budget can only be used for the cash, or only the cash budget may be prepared on a rolling basis. Okay. So, the type of product and the culture of the organization. So what must I consider? Something just like what we discussed now in terms of that ZBB question. Okay, factors to consider in changing the system. How long will it take? Do I have staff to help me implement the change? How long does it take in terms of management time? What is the training needs, and what are the costs as against the benefits? Okay, right. How I was mentioning this, how do you incorporate risk into budgeting? Flexible budgets, rolling budgets, scenario planning, sensitivity analysis. If you have a rough idea of those, that's fine. Okay. We're going into a flexible budget question, after which we come back and look at a few aspects connected to uh, learning curves, high-low method. Okay. So learning curves, high-low method, of course, or let me look at that and after that go into that particular question. Okay. So high-low method, this is nothing that I need to specifically tell you. Select the highest and lowest activity levels. I want to stress on that. Don't pick the highest and lowest costs. Go with the highest and lowest activity levels and their cost. Okay. Variable cost per unit, that is the change in cost over the change in the activity level. And then we have the fixed cost, that is the total cost minus the total variable cost, which you calculate in part 2. Okay, right. So then I move on to learning curves. This is the formula. Okay, the average time formula. Okay, so ideally it's mathematically I have come up with a total time formula as well. It's not given in your table or whatever. It's basically just a +1 added to b as a power. Okay, so just keep that in mind. We are not going to do a question today. We're going to do a question tomorrow. Yesterday I remember there was a request on my MRMC pricing, so I'm going to do that tomorrow. And that question also includes, if I can recall correctly, something to do with a learning curve as well. So I'll cover all of that. Okay, so now we move on to Noble on page 3 of our tutes, after which we come back and do variances. Okay, right. So go to page 3.
Yeah, so that's page 3. Okay, so a flexible budget. Okay, uh, one of the rare flexible budget questions available on past papers. Okay, so from way back in 2011 actually. Okay, so let's see how we can look at that. Okay, right. 1 second, I'm just looking at some questions. Do we have to answer the questions as the same way it is described in part B? Not necessarily, Tasneem. What you will have to do is come up with an answer which has similar ideas and thoughts and points, okay, presented nicely. Not necessarily every idea and point as well. Okay, right. Will you please, I'm sorry, I missed a question probably. Uh, Step fixed cost, please explain. So this is a situation where, okay, step fixed cost is where you have a particular fixed cost. Now, for example, let's say a warehouse or something like that. The rent of the fixed cost, rent of the warehouse is the fixed cost, which is about 100,000. But you and I know there is a specific limit of storage space there. So if this warehouse is not sufficient, you will have to go for a bigger warehouse. Okay, so and the bigger warehouse will not be 100,001, but obviously something like 130,000. So that 30,000 increase is the step fixed cost. Okay, so that's your answer, Arif. I hope you got it. If that warehouse is also not enough, then you got to go for a 200,000 warehouse, okay, which is even bigger. Okay, I got a flexible budgeting question which had budget for 1 year and the actual results for 6 months. Okay, so when it comes to fixed costing, should I flex the fixed cost for 6 months and find the variance and compare the 6 months fixed cost with the budgeted fixed cost for 1 year? That depends on the fixed cost being an annual fixed cost or a monthly fixed cost. Now, in the context here in Sri Lanka, if you take something like a rental component, generally those are paid on a monthly basis. So if that's the case, you got to take a 6/12. But if you take something like rates paid on the property, that's an annual payment. So there you just have to take the whole thing, because even if it's 6 months, okay, it's just a constant amount which is paid for that particular period. Okay, right. This is my view. Coming back to the question, Noble is a restaurant that is open in the evenings on 6 days of the week. It has 8 restaurant and kitchen staff, each paid a wage of 8 per hour on the basis of hours actually worked. It also has a restaurant manager and a head chef, each of whom is paid a monthly salary of 4,300. Uh, Mutually exclusive and incremental packages. I think I answered this question. Okay. Mutually exclusive, two packages which cannot happen at the same time. Incremental, that is what I said, extra seats in the seating arena. Okay. So what's the additional amount? Okay. Right. So questions are done. I'll take questions after I do this. It has 8 restaurant and kitchen staff, each paid a wage of 8 per hour on the basis of hours actually worked. It also has a restaurant manager and a head chef, each of whom is paid a monthly salary of 4,300. Noble's budget and actual figures for the month of May was done as follows. So prepare a flex budget. That's what they're asking over there for the month of May, assuming the standard mix of customers remains the same as budgeted. Okay, you're welcome, Abdullah. Right, the budget above is based on the following assumptions. Okay, the restaurant is open 6 days a week. Okay, so maybe I think certain things need to be highlighted over here. Okay, so you're talking about 6 days a week, 4 weeks in a month, number of orders 50 per day, spread across all days, or evenly spread across all the days in the month. The restaurant offers two meals, meal A, which costs 35 per meal, and meal B, which costs 45 per meal. In addition to this, irrespective of which meal the customer orders, the average customer consumes 4 drinks, 250. Therefore, the average spend per customer is 45 or 55, depending on the type of meal selected. The May budget is based on 50% of the customers ordering meal A and 50% ordering meal B. And then food costs 12.5% of revenue, drink costs 20% of revenue. When the number of orders per day does not exceed 50, each member of the hourly paid staff is required to work exactly 6 hours per day. For every incremental increase of 5 in the average number of orders per day, each member of the staff has to work half an hour. Okay, so that's an important piece actually. Okay, of which they are paid an increased rate of 12 per hour. So certain proper calculations need to be done. You should assume that all costs, hourly paid staff, are treated wholly as variable. Energy costs are deemed to be related to the number of hours worked by each of the hourly paid staff and absorbed at a rate of 2.94 per hour. So I need to prepare a flexible budget. Let me clear this. Let me go back and let's start that. Okay, right. Why do I need to prepare a flexible budget? That's 1560, that's 12, it doesn't tally. So I generally ask this question, can I make this 1002? Answer, no, I can't. So I have no choice but to make this 1560. So prepare a budget or basically redo this piece for 1560 meals. Okay, right. So let's quickly go on to our platform. Okay, so I will say ACCA constructed response workspace. Okay. By the way, like what happened yesterday when we were doing this session, okay, there's a bit of a glitch in the system which I got it basically which I got it got confirmed today through the ACCA staff. Okay, uh, it'll not be the case at the exam, so don't worry unnecessarily if the same problem will be there. Okay, but we found a temporary solution to it. Okay, not the most convenient easy solution, but we found a solution to it. So go to Excel sheet, anything's fine. Yeah, so we have the solution. I'll show you the solution. We have a 2 and a 3. I can't select 2, that was the problem, but I can always say C2 plus C3 and I get my answer. Okay, so temporarily today we will manage like this, guys. Okay, right, so there you go, C2 plus C3, although generally you should be able to pick it up by clicking on the cells, but sadly doesn't happen. Okay, so they will actually try to correct this problem. Okay, so but till then we will manage. Okay, so we're looking at putting this down now. So get this organized quickly. Okay, so this is a good question to actually practice on the system. Number of meals. So the budget, and I'm going to make it 1560. So then dollars, if you like to make it nicer, center it. Revenue, food, drinks. Okay, so then there's variable cost, staff wages, food cost, drink cost, energy cost. Okay, so there's food cost, drink cost, there's staff cost and energy cost. So if you add all of that, and revenue minus variable cost is contribution, and from the contribution I minus the fixed cost. If you want to make it nicer, put a minus sign here too. And what are my fixed costs? There are two fixed costs given in the question: managers and chefs pay, rent rates and depreciation. Rent rates and depreciation. So then I end up getting profit. There you go. So fill all of this. Okay. So in terms of revenue, 1560, half of it they say 50% meal A, 50% meal B. The food cost is 35 and 45. Okay. So easy working there. Equals D2, that is 1560, into 50% into 35 plus D2 into 50%, that is meal B, into 45. Okay, so that's your answer there. You can see the formula over there. Drink cost equals D2. Each drink is 2.5, or ideally, hold on, 1560 meals. Each person has 4 drinks, and the drink is 250. So if I get revenue, underline that to make it nicer, equals this plus this. Oh, sorry, doesn't work. Equals D4 plus D5. There you go, done. Ooh, I've messed up this. Cut, paste. Cut, paste. Right. Let me knock that off. We need an extra line. Energy cost. Sorry about it. Right. So what do they say about food cost? Is 12.5% of revenue. Drink cost is 20% of revenue sales. Okay. So 12.5% and 20%. So equals D4 into 0.125 equals D5 into 0.2. Okay. Staff cost. Hold on to that a little bit. I'll go to the fixed cost, remains the same. So let me do that and finish it off. 8, 6, and 4, 5 include it. So my total fixed cost is the addition of these two, which is this plus this. Oh, sorry, doesn't work. Forgot that. D15 plus D16. Right. So if I get these two answers sorted out, okay, I get a subtotal there. I'll say equals sum, open brackets, D8 to D11, close bracket, center. So if I get that total sorted out, contribution is E6 minus E11. Okay. And if I get that total sorted out, it's a matter of getting this final total, which is E13 minus E16. Okay, right. So staff cost and energy cost. That's the only thing that we need to do. Okay. So let me say working one. Okay. Working one. Right. So there's a bit of a story which they said. I said it was a little important. Okay. This piece. If you read the question, they are functioning 6 days of the week and there are 8 staff. Okay. Working for 4 weeks in a month. Okay. 6 days a week, 4 weeks in a month. There are 8 staff, and how many hours per day do they work? That was also mentioned somewhere. 6 hours per day. Okay. So the total hours on a normal basis, okay, uh, 8 staff, okay, 6 days per week, 4 weeks in a month, and 6 hours per day. Okay. So the total time available on normal basis, okay, is equal to, or shall we, okay, I'll say normal hours. So then there's overtime hours also, no? Right. So the hours, let me put it over there as a small heading. So that is how much? Equals 8 into 6 into 4 into 6, 1152. And if I put the rate over here, the rate is 8 and the OT rate is 12. So if this is 1152, sorry again, I6 into J6. And let me copy this and let me paste that over there. And let me get the addition of this. K6 plus K7. So if I get my OT hours, I am good. And that answer, this answer that is on K8 should come over here. Okay. Right. So what is my OT hours? Okay. So the question said average meals per day is 50. Okay. Uh, that is the target ideally. Yeah? Actual average meals per day. Okay. $50. Actual is 1560 is the total meals divided by, we are functioning on 6 days of the week for 4 weeks, for 24 days. So now what they are saying is for every 5 extra meals, okay, each member of the staff has to work half an hour of overtime. Okay. And we have 8 staff members. So I'll say extra meals per day. I'm going to do a mental calculation there and say 1565 minus 50. Okay. So OT hours, required per staff member is 15 divided by 5 into 0.5. For every 5 extra meals, half an hour per meal. So 1.5 hours per staff member. So I have everyone, 8 people working for 6 days for 4 weeks, and every day each guy is putting up 1.5 hours. And there you go, that's your answer. By the way, let me get this total also. I'll tell you why. Energy costs are deemed to be related to the total number of hours and absorbed at a rate of 2.94 by each of the staff members. So therefore, on that note, your answer will be 1,440 into 2.94, and voila, I'm done. That's your flexible budget. Taking some questions quickly. Eight staff members given in the question. Is it possible for, is it more than one? Yes. Okay. When it comes to the computer based exam, different students get different questions. So the person next to you can actually get a different paper. Actual is 1560, yes. The budgeted number of meals being 1, 2, and the actual is 1560. The difference is 360. Okay. Number of the meals is favorable variance, right? We don't have to show that. No, they're just asking the flexible budget over here. May you show how to insert a row in case I leave out? I don't think you can insert a row over here, but like what I said, what you can do is, let's say, okay, something needs to be entered in between this and this. Move it and now enter it. That's the only thing you can do. These right click inserts and all don't work. Keep in mind, this is not Microsoft Excel. Okay, right. How do you open the workspace? Go to Google constructed response workspace and say access workspace. Okay. Yeah, just joined in. I'm sorry. We are done with transfer pricing. Okay. And let me quickly take these few questions. Can we directly calculate revenue for 1560 48,000? Yes, if it's like a, yes, Osama, you're right. If it's like 100% variable cost, yes. Do I need to show the working separately if I calculate all the things doing the formulas? It's best if you show the workings, like what I said yesterday. If the answer is wrong, then you lose marks. Yes, I'll share my email ID. Yes, I won't. I will definitely do that. Don't worry. Uh, you don't need to write any comments on this because they are not asking. They just want you to do the calculation, Shihab. Can you repeat the overtime working? I'll quickly do that. If the budget is set up from scratch, is it also called a zero-based budget? Yes. Okay. If you're starting something from the beginning, generally you call it that. Okay. We'll take a break right now. I shall just stay for a minute. I'll show you the overtime working. Others can take a break. Okay. In about 5 to 10 minutes, we'll be back. Okay. Right. Yeah. So the overtime working, by the way, is average meals per day is 50 given in the question. Actually, it's 65 per day. And extra meals will be the difference between the two. And for every 5 meals, each employee has to work for half an hour extra. So 15 over 5 into half an hour. So every employee works 1.5 hours. So it's this same working, which instead of the normal 6 hours, you put 1.5. That's how you get the OT hours. Period budgeting is where you prepare a budget for a particular period. Incremental budgeting is where you take previous period's budget and adjust it for changes in inflation. And if there's a difference in the quantity, you do that adjustment also and prepare a new budget. That's an incremental budget, Adele. Fine. So I'll take a break and come back. I'm back, guys. Hope you're back too. Uh, mm, what is the name of this question? I want to search and let know the company name of this question. Uh, Imran. So if you are referring to this question, this is Noble from June 2011 past paper. I'm sure it will be there in a approved examination kit or a revision kit as we call it. Okay. How to open the ACCA constructed response workspace. Click on ACCA constructed response, sorry, search on Google ACCA constructed response workspace, and the first result will be this link. Click on this and you're there. This is to Salman. Okay. Food and drinks revenue. I'll show that. Why is ZBB suitable in allocating resources in areas where spend is discretionary? What do you mean by the discretionary? Is more in line with fixed cost. Discretionary costs are mostly fixed costs. How do you find the out the hours required per staff member? The logic behind it. Uh, so basically, each staff member works according to the question given. Okay, uh, 6 hours per day, and if I need uh, to make 65 meals, each guy must work 1.5 hours extra per day. Okay, fine. Product line, there's a request for a definition. We'll touch on that tomorrow. The energy cost again. And there was one more question which asked me to show food and drinks revenue. Sure. So with those two, we'll move on to the rest. Okay. So food and drinks revenue is half of this, that is 50% into 35. That's the cost. The balance half of it is 45. So that's meal A, that's meal B. Drinks revenue is this, each person has 4 drinks. I don't know how you can do that, but supposed to have 4 drinks into 2.5 per drink. Energy cost is this total number of hours of 1440, okay, into 2.94 per hour. Okay, so I hope that's sorted out. So I move on. Let me clear this screen, or let it be there. Let's move on. Right. So variance analysis. Okay. So we have mix and yield variances, sales mix and sales quantity, other targets for controlling production. Sorry, let me clear this. Other targets for controlling production, planning and operational variances, and modern manufacturing environments. Okay, right. So first of all, we have mix and yield variances. This is how you do the computation. Okay, right. So there was a request. There's 2 questions to do. It's MCQ time over here. But then again, let me leave that MCQ. Okay. And shall we go into this question? Okay. Ideally, Kappa company on page number 7 of today's handout. Okay. Right. So a mix and yield from the latest past paper, which is mentioned. Okay. So they want you to calculate the usage variance for each ingredient and in total. Okay. Right. So the material mix variance and the material yield variance. My main focus is that. Okay. So for 11 marks, that's, I would say, in my point of view, 11 marks given to you on a silver platter. Okay. For you to take very easily. Okay. Right. So let's start. Kappa company produces omega, okay, an animal feed made by mixing and heating 3 ingredients, alpha, beta, and gamma. Okay. So alpha, the institute that I represent today, Alpha Business School. The company uses a standard costing system to monitor its cost. The standard material cost for 100 kilos of omega is as follows. So they give you the details. I don't know if you notice this. You better notice it. There is a loss included. To get 100, you need to include 120. The mixing and heating process is subject to an evaporation. They are mentioning it anyway. Alpha, beta, and gamma are agricultural products, and their quality and price varies significantly from year to year. Standard prices are set at the average market price over the last 5 years. Kappa Company has a purchasing manager who is responsible for pricing and supplier contracts. The standard mix is set by the finance department. The last time this was done was at the product launch, which was 5 years ago. It has not changed since. Last month, 4,500 kilos of omega was produced using the following inputs. There's alpha, beta, and gamma. Okay. At the end of each month, the production manager receives a standard cost operating statement from Kappa Company's performance manager. The statement contains material price and usage variances, labor rate and efficiency variances, and overhead expenditure and efficiency variances for the previous month. No commentary on the variances is given, and the production manager receives no other feedback of the omega process. Okay, right. So let's quickly look at usage, mix, and yield. Okay, right. So how do you compute the usage variance? I think we will have to clear this. Okay. So there are different approaches. Okay. I tend to follow this approach. Okay. It's actual quantity into actual price, and actual quantity into standard price, and standard quantity into standard price. I call this the difference between the actual at standard comparing it with the standard. Okay. So I'm gonna do 3 answers, okay, for the 3 products alpha, beta, and gamma. Okay. So alpha, beta, gamma. Okay. Actual quantity at actual price. Okay. So actual quantity at standard price, 2,200 into 2. So how about beta? So do that over there. 25 into 5. How about gamma? 920 into 1. Right. So the standard prices I know are 2, 5, and 1. What is the standard quantity that I need to use? Okay. Right. So the standard quantity that I need to use, so according to this, for 4,600 kilos, okay, for 4,600 kilos, I am supposed to use, just 1 second. Yeah, so if it was 4,600 kilos. So I should have used 4,000. I should have used equals 5,600. Basically, 5,620 is the actual usage, but to get 4,600 kilos, what we're going to do is we're going to take the respective proportion. Okay, just a second, I'm looking for a calculator. Okay, right, thank you. So let me get the figure again. So 5,620 is the total kilos. Yeah, so this is how it's done. So which is 4,620. So for every 100 liters, I have to use 120 liters. Okay, so if I'm to do a multiplication there, that's 5,500 and wait, 4,600, sorry, 5,520. Let me pull this down a little bit. So 5,520, let me keep that over here, which is C7 equals 5,520. Okay, and the proportion of alpha is 40 over 120. So I'm getting 1840. This is the quantity that I should have used, and that needs to get multiplied by the standard cost, which is 2. So that's a 3,680. Okay, right. So when doing this comparison, I'm supposed to spend so much, I'm spending more. Spending more is bad. And bad is adverse. There you are. So that's the 720 adverse variance. So similar story applies over here. So again, to get the 4,600 kilos of output, according to what they say here, I need to include 5,520. So taking the loss into account. And then from that 5,520, I take the respective proportion for alpha and that into the standard price of 2. So same thing applies over here. equals C7, or let me get the respective proportion first. 40 over 120, now it's 60 over 120, and the standard price is 6. So 60 over 120, standard price is 6. So equals C7 into 60 over 120 into a standard price of 6. So that gives me that particular answer. Okay. Wait. Sorry, the standard price is 5. So, and copy this and paste it, and I will get the 1300 favorable over there. It's a bit of a tricky question. So this was requested to be done. That's why I'm doing it as well. Okay. So that's adverse, that's favorable. Right. So similarly, I will have to look at this as well. Okay. So how do I do that? Okay. So basically same story, but now I have to go on 20 over 120, and the standard price is 1. Okay. So this C7, 20 over 100, let me see if I can copy and paste that over there. So that becomes C7, okay, and 20 over 120, and the standard price is 1. And therefore, if I copy and paste this, that's a 0. And if I take total usage, okay, that's going to be this, that is D4 plus H4, okay, equals D4 plus H4, 580, and that's a favorable back again in terms of the total, right? So there's some questions. I don't know what. Okay, let's look at this. Okay. Uh, for alpha will be 4600 divided by 100 into 40. Okay. So if it gets the same answer, that's also fine. Okay. Is it 46 divided by 100 into 40? I don't think that's the same answer. Okay. 1840 into 2. Yes. Yeah. That's fine. Okay. Can you please tell again about the 5520? Okay. So let's me show the 5520 in the answer cell. You didn't think. Could you please show us 5520? Where's 5520? Yeah, there you are. 5520. So this is basically based on the loss given in the question, which where they say when you put 120, you get 100. So if you are getting a 46, which is equal to 100, how much is 120? That's the 5520 divided by 100 into 120. Right. So let me do the mix variance in the tabular approach. Type actual standard difference, standard cost variance. Okay. So I have 3 types: copy alpha, copy beta, and copy gamma. The actual amounts 2225,920, 2225,920. So add it up, equals C10 plus C11 plus C12. Okay. Standard. Okay. So I need to split this 5620 among alpha, beta, and gamma. How do you do that? Okay. The standard ratio is 40, 60, 20, 4, 6, 2, or shall I solve it further and say 2, 3, and 1? That's also fine. And the addition of that is going to be 6. So 5, 6, 20, that is B14, okay, into 2 over 6 equals B14 into 3 over 6. B14 1 over 6. Get it to 2 decimals so that it's clearer. 1873.33, 2810, and 936.67. Copy and paste this. If you have done your proportions properly, these two totals will always, always, always be the same. Difference, I'm supposed to use so much, I'm using more. Using more is bad. So that will be D10 minus C10. Okay. So copy and paste. And if I take a sigma over there, that is ideally supposed to be equal to 0, and it will be if you've done it properly. Okay. Multiply this by the standard cost, which is 2, 5, and 1. So equals E10 into E11, F10, sorry. Copy, paste, paste. This is adverse, this is favorable, this is favorable. Copy and paste 913.33 as a plus answer, so it's a favorable. There you go, that's your mix variance. Okay, quick summary, take the actual figures and then the standards based on the standard proportions where you split it out. Take the differences, multiply by the standard cost, and add it up to get your mix variance. Right. So then we'll move on to the yield variance. Okay. So I generally use a bit of a shortcut of an approach. Okay. Actual output, expected output. This is against the traditional textbook method, but always is right. And if my student got the world prize, I'm sure it's approved by the examiner as well. Standard cost per kg, yield variance. Okay. So the actual output, according to the question, is 4,600 kilos. What is the expected output? Equals 5,620. That is your input. For every 120 kilos, I get only 100 kilos. So that's what I expect. So I expected so much and I got less. which means it's an adverse variance, L9 minus L10, an adverse of 83, but 83 adverse in terms of kilos. So some sadly stopped there, which is wrong. So if I multiply this by the standard cost per kilogram, then we are good. Okay. So what is the standard cost given in the question? Has it been given? Yes. 400 is the cost for, think an answer. I want an answer. 120 kilos or 100 kilos. If you get that wrong, your answer is wrong. So when you say standard cost per kilo, it's 400 over 120 or 400 over 100. How expected output is calculated. There you go, you can see it. Muhammad, I hope you got it. No, Abdullah, it's not into 100 over 120. When I say standard cost per kilo, you ideally have to divide it by either 100 or 120. I'm asking what? I'm not getting any answers. Shall I move on? When you're computing, okay, I'm getting an answer saying 120. Another answer, 120. Can I wait for one more? It's not 100 over 120, Salman, because I'm going with kilos. Okay. If I want standard cost per kilo, in this case, I have to divide 4,000 by the number of kilos. Okay. So if this was standard cost per unit of output, where they say so many kilos is 1 unit, yes, you're right. Okay. So again, another answer, okay, 120, because it's 120 actually, but it's actually wrong. You need to take 100. So equals, I'll tell you why. 400 divided by 100 is 4. So equals L11 into L12. So that's a minus, which means it's an adverse 333 adverse. Okay. Keep in mind, guys, when computing the standard cost per kilo or liter or unit or whatever, in a situation where there is a loss, you will have to always compute standard cost per kilo of output and not input. Okay. So that's why you take the 100, 333.33. Okay. So if I am to show you, okay, the examiner's answer, okay, for this particular question, ACCA PM past papers, okay, as a more sorry, PM. So the answer goes like this. So 589,13333. So what do we get? 589,13333. We are good. We're perfectly all right. But what I'm trying to stress on is, okay, majority go with this format for yield variance, okay, which is a very lengthy approach. Okay, uh, up to you guys. Okay, see, alternative solution is what I am doing over here. It's a very fast approach to get the answer. Okay, many of the approved textbooks follow this approach, but the shortcut is definitely right, and it's seen and given by the examiner as well. Okay, if you're very comfortable with this approach and if you're always getting your answer right, please stick to it. Okay, you will get full marks on that as well. The answer is right. Okay, right. So that was a requested question, so fine. Explain the beta calculation. So in terms of Mohammed, can you repeat the beta calculation? Where are you referring to the beta calculation, in usage or mix? Usage. Okay, so like what I said, 5520 is the number of kilos or that you need to get an output of 4600. Okay, but that is total number of kilos. So beta, the question says from the total of 120, 60 is beta. So I'm going to take that total number of kilos into 60 over 120 and multiply by the standard cost. There you are. Okay. Repeat the calculation of standard cost. Sure. 100 in over 400 over 100. That is this over this. Yeah, that's the 4. I am telling don't take this. That's what I'm saying. A lot of people do that mistake. Like even some of you said 120. No, it's 100. In a situation where there is no loss, this is also going to be 100. This is also going to be 100. Then it doesn't make a difference. But when there is a loss, it's always standard cost per kilo of output, not input. Okay, right. So we are running short of time a little bit. Okay, so therefore I will move on to the next question, which is valet company on page number 4. Okay, question: if we are required to do yield variance on a per unit basis, we will have to divide the standard cost by the input. Yield variance in units, we will have to find a standard cost per unit and include that value over here. If it's a standard cost per unit, or if the details are provided in units, I have to find the standard cost per unit. Okay, right. The calculation is done. Okay, right. We move on to the next question, like what I said on page number 4. Mix and quantity variance, sales. Okay, so similar structure, valet company is a car valeting company. It operates in the country of Strapia, which has been badly affected by the global financial crisis. Petrol and food prices have increased substantially in the last year, and the average disposable household income has been decreased by 30%. Recent studies have shown that the average car owner keeps their car for 5 years before replacing it, rather than 3 years as was previously the case. Figures over recent years also show that car sales in Strapia are declining while the business for the car repairs is on the increase. Valet company offers 2 types of valet, a full valet and a mini valet. A full valet is an extensive clean of the car inside and out. A mini valet is a more basic clean of the vehicle. Until recently, 4 similar businesses operated in valet company's local area, but one of these closed down 3 months ago after a serious fire on the premises. Valet company charges customers 50 for each full valet and 30 for a mini valet, and this price never changes. Their budget and actual figures for the last year were as follows. So mix variance and the quantity contribution variance. Okay, We have only a few minutes, so let's quickly do this. Right. So let's move on to, I'll take a new sheet. So sales mix and quantity, type, actual, standard, difference, and according to the question, it is standard contribution. In another question, it can be standard profit. Okay, to get the variance. Right. So we have two types of valleys, that is the full valleys and the mini valleys. So actual sales given in the question as 4,000 and 3,980. Okay, so 4 plus 3,980 is equal to C3 plus C4. Standard, I have to split it according to this ratio. So what's the ratio? 36 2000, or shall I say 36 to 20, or shall I say 18 is to 10, or 9 is to 5. So 9 is to 5, which means addition of 14. So equals 7980, okay, into 9 over 14 equals 7980 into 5 over 14. This addition, just like before I said, must be the same. You are supposed to sell so much, you are selling less, that's bad. Okay, so that is D3 minus C3. Standard contribution is 50 into 44.6%. And then we have 30 into 55%. So like what I said, the addition here has to be a 0. So this is E3 into F3. That's a plus answer, so favorable. Copy and paste. That's a minus answer, adverse. Right, so that's altogether favorable. That's the mix variance. Quantity variance, actual sales, expected sales, no, here we call it budgeted sales, difference, standard average contribution per unit, and the quantity contribution variance. So actual sales is given in the question as 7980, budgeted is 56. So here I am actually more than the budget, 2380 plus. Standard average contribution per unit, if I get that, I have my answer. So what is the standard average contribution per unit? So the contributions are 22.3, 16.5, 36 and 2000. Okay, so equals 36 into 22.3 plus 2000 into 16.5. This is for 5,600 units.
So this answer, that is 2380, that is M5 into M6, is the answer that we are looking at. I think there's a bit of a typing error. Yes, I was right, 2000 there. So 48,143 is my answer, which is a favorable. Okay. So in terms of, we have just 1 minute left. Okay. So the session will cut off soon. Briefly describe the mix and the quantity. Mix variance is where you sell a different mix to the standard mix. Quantity contribution is where you sell a different quantity to the budget. Okay. So if I'm to take some of the questions, okay, if we are required to do the yield variance on a per unit basis, we'll have to divide by standard cost. Yeah, we did that. When are you going to do the learning rate tomorrow? Yes. Okay. Can you send the files via email? You can download it from the side of your software. Okay. So the part C question, okay, discuss the sales performance. So by the looks of it, okay, you are actually doing super brilliant. Okay, both are favorable. But sorry, this is adverse, by the way. Wait, I'm supposed to, this is adverse. Okay, so if I think I got it wrong, I'm supposed to sell so much, I am selling less, that is bad. Okay, so it's actually C3 minus D3. Apologies. So control C, control V. Okay, so this is adverse, this is favorable, this is adverse. So but I am actually, this is that rare case where I am an adverse and not bad. Okay, so ideally, if you want, since time's up, we'll come back tomorrow and look at the explanation and planning and operational variances. That's what's left to be done. We'll look at that tomorrow. Okay, right. uh, Standard contribution. Okay, so I'll show that to you, and we will call it a day. The session might time out soon. Okay, good night, guys. Thank you so much for participating today. So we're going to continue tomorrow from planning operational variances onwards, and we're moving on to decision making techniques. Okay, yes, you're welcome, Mohammed Abdullah. You're welcome as well. Thanks, guys, for participating. Okay, you can download yesterday's video already. Today's video will be up within by tomorrow. It'll be up. Okay, you're welcome, Wazim. You're welcome, Furby.